Hi, Vince Oldry here again, and I want to thank you for watching another video. But we are in a position where the stock market is at all-time highs, which is great, but it can also be very scary at the same time. We're all wondering, when is that next stock market crash going to happen, and how much will it go down? We're also wondering how much it will affect ourselves when it comes to our own retirement. Now, what I've done here is I've listed 6 things that you can do to help protect yourself from the next stock market crash, and also avoid some of the things that we feel like we might be preventing ourselves from the next stock market crash, but we'll end up finding that maybe we aren't doing what we should be doing. So number 1 is to have a warning system. What do you have in place that's going to tell you that your funds are going down and at what point they're going to be in a spot that you're not comfortable with? Now, sometimes you will get quarterly statements, and if you just rely on your quarterly statements, you could be for a big surprise at the next quarter. You might be watching on the news that the stock market might be going down, but you don't think you're that diversified, or you think you are very diversified, so you just don't know what's going to happen until you get that quarterly statement. Now, that's the exact thing not to do, is to wait for your quarterly statement. You need to have a warning system. What we use is a thing called Wealth Guard. Now, we have a video that will attach to this this blog here, or this video, where you can watch what Wealth Guard does. Now, what we do with Wealth Guard is it helps monitor your 401ks, your IRAs, whatever retirement vehicles you want attached to it, and it will give us a warning system when we lose more than what we're comfortable losing. What we say is, losses hurt you more than gains help you. If you lose more than 50%, we need more than 100% gain to get back to break even. So losses hurt you more than gains help you. So we want to make sure that we are protecting your losses by having a warning system. Again, if you don't have a warning system like Wealth Guard or something that will warn you about the losses in your retirement, let us know and we can set you up with Wealth Guard at no cost or obligation. Number 2 is to diversify your investments. Now, sometimes we feel like we might be diversified when we're in multiple different mutual funds. But what we find out when we do a Morningstar report is that most of your mutual funds all own very similar stocks or holdings. And that means you're really not that diversified. So when we look at the historicals of all the different mutual funds, we might find that you might lose more than what you really want to lose. Even though you might be in a 40-60 stock bond mix or a 60-40 stock bond mix, and you feel like it's a rather conservative model, you might be in for a big surprise when the market decides to correct itself. Even the target date funds, when we had the big stock market crash in 2008, we found out that a lot of these target date funds, even the 2010 target date funds, lost over 20 to 25%. Now, that's significant, probably a lot more than what you want to lose if you're 2 years away from retirement. So make sure you're diversifying correctly, not just in US stocks, but also international, not just in stocks, but also bonds, not just in one mutual fund company, but in multiple mutual fund companies. But then do an analysis as far as what the holdings really are. Are they actually holding separate stocks? And by doing a Morningstar report, you will find that out. Now, if you can't have access, or if you don't have access to a Morningstar report, we can do one for you. But otherwise, you can go to Morningstar and you can get one report done for you. I believe there's a monthly fee if you want to subscribe to them, if you want to. Now, the next thing is to not risk more than what you are willing to lose. What do I mean by that? Well, I mean your risk capacity. Your risk capacity is how much can you lose and still maintain your lifestyle. So if I can't lose more than 25% of my portfolio, that means I don't want to take risk with more than 25% of my portfolio. I can't lose more than 25% to maintain my lifestyle. So understand your risk capacity. The other one is your risk tolerance. Now, your risk tolerance is something different than your risk capacity. Risk tolerance is more your emotional risk. And that's by understanding, if you get your quarterly statement in the mail, how would you feel? You don't want to make irrational decisions when you get something in the mail and you can lose 25% and then you realize you lost 25%, and then you accidentally get out of the market. Now, a lot of people did that in 2008. What they were doing is they were thinking about how much money they had, how much it shrunk down to, and how many years that money is going to give them for income for the rest of their life. Now, they looked at it as I had 30 years and it got shrunk down to 15 years. So don't do that to yourself. Make sure you understand what your risk capacity is with your risk tolerance, but then understand what your risk required is. That means look at how much you need to risk to maintain your lifestyle. If you don't need to go for the big 30 to 40% returns, why do that? Why are you going for 30-40% returns when you're taking 30 to 40% risk? If you just need an 8% return on average, shrink your risk down and just go for a little bit above the 8% and a little bit below the 8%, and you'll average a better rate of return at the same time as reducing your risk. Lastly is know what stage you're in. Knowing the stage you're in means, are you in your preservation mode, your distribution mode, or your accumulation mode? Now, preservation mode is the mode in between, or the stage in between accumulation and your distribution. Accumulation is where you're accumulating your money and saving, and you have time on your side. You have 20 to 30 years to let the market go up and down. So there's not a lot of things you have to worry about. But your preservation is where you're getting closer and closer to retirement. If you're 10 years away, we try to reduce your risk so that you can hit your goals when you do decide to retire. And then your distribution phase or stage is where you now are distributing your money from your retirement plan. And that's where you're taking that income out. And a lot of times we don't need a lot of risk. We just need enough risk to maintain our goals and keep up with inflation. Now, those are 6 things you can do to make sure you reduce the stock market risk that you have and protect yourself from the next stock market crash. I believe there's a lot of things that you can do, but these 6 things where you can have a warning system, diversify, understand your 3 risks, and knowing what stage you are in is critical to helping protect you from the next stock market crash. If you want our help with something like WealthGuard or to get a risk analysis with Morningstar, please let us know by leaving us a message or by coming to our next event, and you can learn more about what we do. Just click on the events tab and you can sign up for one of our next events, or on the bottom of the screen you can click message or leave us a message and we'll get back to you shortly. As always, I thank you for watching and we'll see you next time.